Hey everyone, welcome to part 3 of the JPM Collar and Focus. So today we're going to talk about implied volatility a little bit more skew, and then we're going to break down the performance. I think this is really fascinating. So we're going to look at each and every quarter pretty much of the last 27 quarters of this product and really see how it did versus the upside call strike versus did the put spread really help? What did the market do? And how did it end up at the end of each of those periods? So pretty fascinating stuff. So higher skew, meaning that lower put has higher volatility. So higher skew, meaning that the lower put is actually at a higher volatility than normal, let's say, with higher put skew, that is going to make the call strike that we're selling slightly more distant. So think about that. So if I'm buying a put for $10, and the skew is super steep, and I'm getting $3 for that short put, then my net purchase is $7, right? We've paid 10, we've received 3, so I have a net of $7 outlay. Now I need to find the strike that is giving me a $7 premium from the call sale, right? In order to fund this downside. For now, let's assume that the skew starts to flatten a little bit. So let's say that I'm still paying $10 for this option, but now I'm only getting $2, right? I'm not getting the $3 I was before, still paying 10 for argument's sake, but I'm only getting 2. Now I'm paying $8 for this particular option. So what does that mean when I'm looking for the call? Well, now I have to look for a call that's giving me a little bit more premium, right? And that premium is going to be a little bit closer to the money, because the further you go out of the money on your calls, the less premium you're going to get. So if I'm getting better skew, if this skew is really steep and I'm getting an extra $1 for that put, that's reducing the cost of this put spread, and it's going to allow me to go a little bit further out of the money. Maybe I get an extra 5, maybe I get an extra 10 points of leeway to the upside now, because remember, one of our main risks with this strategy overall is giving away upside, right? You may think of it as a risk. You may not think of it as a risk. You may think of it as mission accomplished. The market went up. I'm capped at a certain point, but I still did well. And I've got downside protection, which is really the way that a lot of people look at it. In lesson number 1, we really looked at how how the performance changes over time depending on really low vol or really high vol markets. 2022, it definitely cushioned the blow of a bear market. In other very strong years, it gave up quite a bit of performance. But that's okay with some people. They may look at this and say, you know what, I don't need to get all the upside, but I don't want to participate in all the downside. And I'm kind of happy to sort of live in that kind of middle lane, and I don't have to knock it out of the park, but I'm still going to do okay in a bull market. But I'm going to have that peace of mind to the downside. So the steeper the skew is here, the more distant this call is going to be. So skew is kind of a beneficial thing from an upside capture standpoint. And a lot of the time when markets are kind of near all-time highs or making all-time highs, that skew can really kick up because people are happy to be long and they're buying downside protection, and they don't mind if they're paying a little bit extra for it. So oftentimes when you're hitting all-time highs, you get that kind of steeper skew. So that actually helps, right? You're getting that little bit of extra premium to enable you to push that call away a little bit. So just a couple of observations there. So now let's look at the actual performance of this thing. I think this is kind of fascinating, right? So this is rather small. So I'm going to zoom in a couple spots here. But I've talked about how one of the main risks is that we're going to give away upside performance with the caller. And so if we look at it sort of out of the last 27 quarters, the strategy, the SPX, breached that upper short call 20 times. It breached the upper call 20 times. Now, it didn't necessarily stay there. Out of the last 27 quarters, the S&P closed above the short call only 12 times. So out of 27 quarters, it actually closed above. It doesn't matter if it passes through the call strike and comes back into the below the call strike, then you haven't given away any upside, right? It's only been a temporary push above, and it eventually came down before the time of roll, time to restructure after 3 months. But 12 times it actually stayed above that strike. So you've given up performance, right? So any close above that upper call strike is going to give us it is going to give away performance, right? So here's your upper call strike. Anything above that, we're not retained. We don't get a cushion of premium here because we've used the whole premium to pay for the downside put spread. So for all intents and purposes, as soon as this thing closes above the call strike on the day of restructuring, you're giving up some performance. And so it's interesting to see that 44% of the time it has actually given up performance. So that kind of gels with some of the stuff we were talking about earlier, which is that we tend to give up performance in very, very strong markets. And the problem is with covered calls is you often do get that very, very strong upside performance. Remember, we talked about skew and how the upside is really compressed. And that's partially because of a fund like this. A fund like this might have 22, 23, $24 billion in notional, right? The value of those calls at that strike price of notional value. That is a massive, massive sale. And there are many other funds out there. The sort of, they call them kind of theta funds or vol risk premium funds that are trying to capture this sort of upside call premium. Those are very, very numerous. 60, 70, 80 billion plus dollars in those kinds of funds. And so there are many, many more funds than there ever used to be selling calls on a fairly regular basis. And that ends up helping to push down that upside skew. So you're not getting as much for that upside skew if it remains, quite compressed. And so when this fund structures this new trade, it's kind of selling something that's kind of on the cheap side. Vol risk premium studies have shown that really the put sale side of things is really the more beneficial place to be. But earlier, that the put side is really demand driven and the call side is very supply driven. And that's why you get something like this. Look at the puts here. We have very nice shoots of positive volatility risk premium. This is where generally you can say that puts are more expensive than they should be based on risk, right? So the market under realizes it doesn't move enough to justify put prices. So you get these nice juicy put premiums over time. It's the study over 10 years from March 08 to March 2018 and beyond a little bit. So this is really showing you. Now let's look at the call side of things. Look how kind of meager these shoots are in terms of vol risk premium for call selling. Very, very thin. Look at that. There's really not a lot of benefit there. And so really what you're looking at is what we've been talking about the whole time, which is the fact that puts tend to be juiced and calls tend to not be so juiced. You've just got to be much, much better at this as a call seller. And so the JPM caller is really suffering from this reality that upside calls that they're selling just oftentimes kind of give up upside, to giving up upside. And that's what's happening here. So let's take a close look at this. We can see that 44% of the time we're giving up performance. Now, how often are we using that put protection to the downside? Well, out of the last 27 quarters, the S&P entered the JP Morgan long put short put spread 4 times. So it entered the put spread 4 times. So here, 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 and here. Now, which ones successfully protected performance? It looks like here it did, right? Because we closed below the long put. So anywhere below that long put, a close will be benefiting from the protection here. So even if we close below the short put at the bottom, we're still benefiting from this put spread down here. Now over here, we see that we basically went right through it. And at this point, it was really, really helping to shield some downside. But then the market came back and closed right about near the bottom. So you got maximum benefit out of this particular structure here, which would have been, I'm trying to look at the date here. That would have been in during COVID, right? So that was early on in 2020. And this structure, this JPM collar structure really, really helped. Now, then unfortunately, it started a very, very strong upward trend that got breached, where the upper call strike got breached many, many times. So we can see here, got breached here. See, here's your upper call strike in the green. It got breached here. So we have very big underperformance versus the underlying index. That's how you can kind of think of these things. Well, how are we doing versus the underlying index? If it breaches to the upside, we are doing poorly. That's called benchmark risk. We're doing poorly versus the benchmark. If we outperform, as we did in here, then we have positive benefit from the collar. So we are outperforming the index, because the index was down way more than this product was. But the problem is these upside breaches are frequent here, here to a small extent, here to a large extent, here again, here again. Here it didn't. Here it popped up above the call strike and then came down to close within. So this was okay. Next one, another strong underperformance because of the upside breach, right? So this whole period where the market was kind of climbing the wall of worry, back in those days, is where even with high levels of implied volatility, they weren't enough to contain the upside performance in the S&P, right? Even though you're getting really nice premiums, the move to the upside was explosive and couldn't contain it. So then here again, we entered into the bear market of 2022. We dropped into the collar put spread and then closed outside of it. So incredibly, even in this terrible month, by the end of the period, sometimes timing is everything, right? So it kind of depends where the product is restructured and when the market performs, right? There's a path dependence to this. It is, the success of it is somewhat dependent on the path of the market, right? That's just kind of one of those things. It's just, there's a little bit of luck involved. So here at one point, the collar put spread was really, really helping. But then we had this massive rally at the end of the period, and it closed above the long put, and so didn't get any benefit. So in this case, I misspoke earlier. In this case, we did close below the upper call strike, so we did not give up performance, but we basically were down as much as the market. So the put spread didn't really get a chance to help us. It did briefly, but by the time we closed between the call strike and the long put, any close within here is basically performing like the market. So if we move up and close just below the upper call, then we perform the same as the market, effectively, less fees and all that, and transaction costs and other stuff there. So you'll underperform a little in the fund, because depending on the underlying basket performance. But let's just say that you basically perform the same as the S&P within this range of the upper call strike and the long put, because the long put doesn't kick in until the market gets down 5%, right? So if it doesn't get down 5% and it just gets down 4%, then you've got this protective strategy on, but it hasn't really done anything for you, because it hasn't kicked in. The protection part hasn't kicked in. And that's exactly what happened here. It started to help. So you felt really good. You were able to sleep at night here because it was doing its thing, and then ended up popping up and being down along with the market. But that's okay. You might look at that and say, well, that's fine. When it really counted, this thing was protecting me. And then when the market came back, well, I lost a little bit of money with the market. But it was effectively going to do its job. If markets kept getting uglier, I would have benefited from a massive, massive cushion down there. So it kind of did its job there, right? And then the next month, down into the collar and the put spread, and the put spread did its job very well, because the product started up here and ended up at the lower end of where that put spread is, towards the short put near the bottom. So it did its job fantastically well, just like back here. But really, and then one more back here as well, right? We started here, closed down in the put spread. So there were really basically 3 months where there was a benefit from the strategy. So this month here, and this month over here. This month, there was a benefit briefly, but it ended up not really doing its thing by the end of it. So there were 3 months that were beneficial, but there were many, many, many months where it got run over, basically. The call strike got run over to the upside. So 44% of the time. Now, it breached the upside 74% of the time. So at some point, 74% of the time, out of all of these months, 20 times out of 27 times, the market was actually above the upper call, but it pulled back so that only 12 times. So that's pretty good. It was basically 8 more times it was above the call strike and then pulled back underneath that call strike so that only 12 times it got run over to the upside. So that's pretty good. I mean, 20 times is alarming. 74% of the time, you were basically giving a performance. But by the end of the structure, by the end of the 3 months, it was only 12 times. But that's still 44% of the time. 44% of the time, you gave up performance. So it's a product where you kind of have to look at it and go, well, okay, there's a purpose. I see the purpose here. It's lowering volatility, but it's lowering volatility to the upside as well as downside. But it's fascinating to look at how it performed because there are some low vol periods in here and there's some higher vol periods and certainly a kind of a bull market, a couple of bear markets really, brief during COVID, but a little bit more durable during the year 2022. So very interesting to see how it goes. But basically, once the stock market starts to get going and gathers momentum and vols drop, what happens when implied volatility drops? Generally, this upper call strike is going to get compressed. It's going to get very, very close to where the market is trading. And that means it doesn't take much to breach it to the upside. So hopefully that's kind of a cool little study that you guys enjoyed on how this thing has really performed. We saw the performance in the first lesson as well, and we're well aware of how it does a little worse in strong up markets and it does a little better in strong down markets. But it is kind of interesting to see how many times it really does get breached to the upside versus giving us really a kind of benefit to the downside, which is really only 3 months of benefit. But this is really, you're kind of seeing exactly that performance that we looked at in the first lesson and why it happened. We're breaking it down by each and every caller over 27 quarters, right? So you're seeing the exact performance of each of those quarters. So hopefully you guys enjoyed that. And again, we are going to push gamma off and we're going to do it next time.